Now, I'm using Realty Income as just the example here, but there's multiple REITs that are in similar situations to Realty Income that have probably underperformed the market. You're probably wondering why. And so I want to just go through this and show you exactly what's taking place. Welcome back in, ladies and gentlemen. Today we're going to go over REITs. What is going on with the REITs? Why are they underperforming? We're going to go from a macro perspective down to individual stocks, talking about Realty Income, possibly the most popular real estate or REIT that's on the stock market. Basically, people love this stock because it is a monthly paying dividend and it's paying over 5%. So what I want you guys to stay focused on in this video is going to be FFO, funds from operation, which adds back in depreciation, amortization, and losses of sale of assets, and then minuses out gain of sales plus interest income. Now, Realty Income is down 16.7% over the last 5 years. This does pay right around a 4 to 5% dividend, currently sitting at 5.58% due to the fact that the price is down roughly 16%. So what you have in front of you right now, the blue line is Realty Income chart and the red line is TLT, kind of following the 10-year treasury here. A lot of what we're going to talk about is going to be debt maturity and interest rate environment. When the red is going down, that means rates are rising. As rates are rising, the red and blue are trading in tandem, almost identical. And there's multiple reasons why this is happening. There is competition now for REITs and dividend paying stocks that have a high leverage amount. So stocks that pay dividends that carry a tremendous amount of debt and rely on the debt market to keep earnings growing are going to be handcuffed to the 10-year treasury. And nothing's more rate sensitive than REITs. As I stated, it is a twofold part. Number one is you can basically get a 2-year treasury for 5 to 5.5%, which is exactly what Realty Income is paying, 5.5%. The only difference is in the 2-year treasury, you're pretty much guaranteed to get your principal payment back. So you're basically getting 5.5% risk-free. But as we see, investing in a REIT like Realty Income over the last 5 years, you're down 17%. So the 2-year treasury is now much more compelling when we look at the equity risk premium of owning a stock. So now that we see the first headwind being that real rates are competitive to dividend paying stocks, especially stocks that need leverage, the next thing we need to talk about is their debt. So we can see here in 2024, they have $1.8 billion of maturity debt coming up, along with 2025, an additional, call it $1.1 billion of debt maturing. That's nearly $3 billion of debt maturing with another $764 million of debt being variable. So this is over $3 billion of debt needing to be refinanced at a much higher interest rate. We can see what their fixed rate debt is looking like, and it's very low interest rate debt here. Everything is under 5%, which now I'm not so sure they're going to be able to get anything below 5.5 to maybe even 6%. So what does this do? This is going to impact future funds from operations, the FFO that we talked about. So the cash flows are going to be impacted. The interest on that debt is going to be much higher, which means that there's not going to be as much funds from operation coming through, and that is going to impact valuations on the stock. And so we're starting to see this being priced in the market. And that's why we're seeing a company that was very popular. It was marketed very well. This was never a cheap stock, but now it's kind of falling into what people think is good value territory. I would just pump the brakes a little bit here. There's a couple headwinds what they're dealing with. Number one is the interest rate on their debt is going to be much higher, especially if 2024 and 2025 rates stay high. If we go into 2026 with rates still remaining elevated, you can see that there's still a substantial amount of debt that's coming due here. It's really going to impact funds from operations, including, once again, $500 million of variable debt on top of the $2.66 billion of 4.1% fixed rate debt. And so when we look at the broader picture of not only is there competition for yields when we look at treasuries, but we also have to discount cash flows even further if rates remain elevated for longer. Not only is that going to be the problem, but acquiring new properties and getting back into a growth phase is going to be a big problem as well. And so this kind of becomes important, understanding the maturity debts that are due for a lot of the REITs that are out on the market, because we are now in a higher interest rate environment. an interest rate environment we really haven't seen in 20 years. And that's why I've been saying, be very cautious in this market, because I do think some things can break here. Companies that are over leveraged, that have a lot of debt maturing, can have some serious issues. We've obviously seen some bank collapses with the speed of which interest rates moved. So it's good to understand the maturity factors of a lot of your, not only just your REITs, but a lot of your stocks that you carry that have high debt. And so this starts explaining how we saw nearly an $80 stock go down to $55 a share. And it's kind of been trading sideways here because the pressure is all related to the 10-year treasury. And so when we look at their diversification outside of the United States, they have 12.6% of their portfolio sitting in the United Kingdom, 1.4% sitting in Spain. And we can see here, though, another problem that this company is going to have is a strong dollar. Another headwind I want to point out is going to be the Dollar Tree store. This is one that's been having problems overall. We can see here that they have 1,200 leases exposed to the Dollar Tree or Family Dollar. And we know that the Dollar Tree has been having substantial issues with its business practices due to higher inflation. And so they've been closing down stores, which once again is going to eventually impact a company like Realty Income. When we look at where funds from operations is sitting right around $4 to about $4.10, and then we start factoring in a stronger dollar is going to probably impact their foreign properties. The maturity dates of 2024 and 2025 could start impacting funds from operation as well. I'm not so sure that the story's not quite done here. Now, of course, if interest rates do start coming back down to more of a normalized level, they'll be able to refinance a lot of this debt, be completely fine. But if the interest rate story is still alive and well here, and we're looking at rates staying above 4.5 and pushing 5% on the 10-year treasury, we're looking at 5.5 to 6% on fixed rate debt probably, which is a substantial increase to where they are today, and that will impact funds from operations as well. So just some things to think about if you're owning REITs, and some of the things you want to take a look at to see if you're safe from these maturity dates and that the company is running efficiently. As always, guys, really appreciate your time. We will see you in the next one.